Tonight on Market Call, David Burrows, president of Barometer Capital Management, and he's taking your calls and emails on North American large caps. Hello and welcome to Market Call tonight. I'm Mark Bunting. We have David Burrows, as mentioned, and you can get your questions ready if you haven't called in yet, or send an email or tweeted us. Here are the ways to do it. There's the email address, marketcall@bnn.ca. The toll-free number, 1-855-326-6266, or tweet us at Market Call, and we'll pass along the question to David. Great to see you.
Great to be here, Mark.
Like the tie?
Thank you. Need a little spring color.
Yeah. Perfect. Very good. All right. So I'm wondering, the last time you were here, you preferred a certain types of stocks, and has that changed at all, or no?
I think that there's some very clear and long-lived themes in this market right now that continue to perform really well. And if you were to break the world into two pieces, the companies that are highly economically sensitive and dependent on, significant future earnings growth, they're not doing as well. And I think that the theme that benefits investors most right now are the companies that are benefiting from monetary policy and have very clear, well-defined dividend policies. Because clearly the thing that investors lack is income replacement, and specifically income replacement cash flow that grows over time. And so companies and themes and sectors that can provide that are slowly trading to higher earnings multiples and higher valuations.
Are there no signs really of it being worthwhile to start to nibble away at any cyclicals of any sort?
Well, so I think that there's that as a core theme. And I think that investors, as they gain confidence, are slowly moving out the curve. They're certainly not making a leap, I don't think, to basic materials and energy and golds and highly sensitive sectors, the really highly cyclical sectors. But I think some of the consumer cyclicals are benefiting specifically in the U.S. as housing improves at a measured pace, because there's some pent-up demand. And so there's some themes around that are benefiting from that as well.
Can you give us a name in that area that is not among your top picks?
Well, I think that if you can look at some of the companies in the consumer cyclicals, like, say, a Disney, right? So leisure is improving, content and media is improving. But again, those are pretty steady cash flow generators. Disney, for instance, is extremely well financed, so it fits into the safety theme, but at the same time it benefits as the economy gets a little better.
Remind us what's working, the sectors you like.
Well, what's working are companies and sectors where their ability to pay is improving. So where they can pay us something that we can depend on, but their ability to pay us more is growing because of changes taking place. So energy infrastructure has been a very big theme for us. It just continues to keep giving to investors. I think telecom fits into that group, albeit with somewhat less upside. I think real estate investment trusts continue to benefit from lower financing costs and very tight supply. And if you went beyond that, I think pharmaceutical and consumer staples also fit into those themes. In the scheme of things, historically, these companies aren't paying out much of their earnings, and they could pay out much more over time, and they're showing a willingness to do it. And so I think that there's some legs in these themes.
You mentioned REITs. Maybe we'll get a question on the Canadian Tire REIT being proposed today. Just lastly, what are you avoiding? Still materials, energy?
We're still not there on materials. Energy producers, I think you have to really pick your spots. Golds, I think we're not there yet. I think this move today in the US dollar and the big move down in the yen tells you that the market's not prepared yet to go out and buy the materials.
Okay, David, a short pause. We'll come right back. Questions for you all lined up and pending on North American large caps.